start. So we'll be looking at indicators. TradingView offers a number of indicators by default. Those are in this page called built-ins. So there's hundreds, if not thousands, of indicators. Some are as old as 100 years. Some are as new as last week. So most of the new ones, mostly made by amateur traders or guys who are just starting out. And I'm a guys who've been around. But most of the classical indicators came about in the 80s, 70s, 60s, thereabout. And some of the guys who made some famous guys who built indicators include guys like Peter Brandt. Peter Brandt made an indicator quali. No, let's say Bollinger. This guy called Bollinger. So I'm just mentioning some of the guys who are alive who's made indicators. Some famous indicators. So this guy Bollinger made Bollinger Bands. Let me just go to Wikipedia. Inventor. I don't know what to call him. Call him an inventor. Should be an inventor. It's called John Bollinger. You can find him. Born 1950. All right. So he made this indicator in the 80s. And his indicator in it were Bollinger Bands. Right. You can look at those on your own. We won't go into them. Into Bollinger Bands. There's another famous indicator called MACD. The indicator. So it's short for moving average convergence divergence, made in the 70s. So it's just classical indicators. It was created by this guy called Gerard Apel, however you pronounce it. And then, so this is just some famous indicators that guys use. RSI is the next one, next famous indicator by this guy J. Wells Wilder. Yeah, it stands for Relative Strength Index. So these indicators show different things. That is, they paint based on calculations of price movement. All right. What's that? What's this thing? Oh, that Forex trading uses brokers. Yes. Yeah, Forex uses brokers. Forex uses brokers. Wouldn't call them brokers. Call them, they call them exchanges. But in essence, yeah, they're brokers. It's just that in crypto world, it's when you use brokers with Forex, you need to go through KYC. Yeah? KYC is just know your customer. You present your identity, maybe a passport, bank account, such things, for them to allow you to access their data onto whatever platform you're trading on. Yeah. So these brokers have access to markets. Yes. But for Forex brokers, they just it's like a way for you to access the Forex market. Right, so you deposit money to the broker's account. Yeah. And then the broker provides you credentials to log in and all that, so you can be able to access financial markets. About Forex time. Yeah, you're talking about time sessions, like European session, London session, and there are those sessions when it comes to Forex. Asian session, Forex session times. Crypto doesn't sleep. Crypto, there's of course there are sessions in theory when it comes to crypto, and most traders will trade Forex. Most traders will trade. Some traders will trade crypto. A good number of them also have gotten into Forex or were trading Forex before. So when they're up, of course, is when they start trading. Yeah, it's when they start trading. So it's based on time zones. When guys are up in Asia, probably guys in North America are maybe asleep, or guys in Europe are asleep. So it's good to know these different sessions when it comes to Forex, because different places, these different zones, people, the traders display different attributes when it comes to trading. There's some sessions where it's slow, other sessions it's aggressive, so you trade accordingly. Yeah, and I think Forex and these other international markets, although Forex is open 24 hours a day, it's broken down to those sessions. And I think on weekends Forex is closed. It's usually closed. So on Sunday, I think it opens on Monday or closes on Friday. So that's also something to keep in mind when trading those markets. And those markets have openings and closings. But crypto is up 247, 365 days of the year. Crypto doesn't have like an opening or a closing. Just maybe in terms of days, the 24 hours in a day. But usually crypto is just awake It's good to keep in mind when Asia is trading as opposed to North America, maybe. Also depending on, yeah. But I don't know much about Forex. I haven't traded Forex a lot, so I'm not an expert. But crypto borrows heavily from Forex in terms of technical analysis. And my mentor is doubles mostly in Forex, in equities and futures. So no problem. So crypto borrows from Forex and other markets. It's relatively new, so of course it makes sense to borrow charting techniques from those guys who've been doing it for longer. TradingView as well offers the same tools whether you're trading Forex or crypto or whatever equities. The same tools available for those guys are the same ones that are available to us. The thing is, different assets need to be traded differently. So the things you begin to notice, even with crypto, different currencies trade, differently. Some are more aggressive than others, some are more volatile than others, some are more liquid than others, some are on some exchanges and on others. So XBT on its own is BTC futures, the BTC derivative contracts are what I specialize in, and I wouldn't make to tell you what other coins, how to trade other coins, because my main focus is on Bitcoin. That said, today we'll look at two, if we have time, 3 indicators. So the first indicator I'd like us to look at is moving average. Yeah, it's good to focus on specific assets. These assets are the entire world's on their own. Yeah, so choose a few that you'll focus on. If it's crypto, just pick a few. If you're doing Forex, just have your own filter for whichever asset you're trading. So we'll look at the moving average, the simple moving average. So you just look for it here, right? Moving, MA, and click it. So once you click it, just close, and here it is. It's this beige line. I'm not sure what color this is, but let me just change it to a better color. Of course, that's subjective. Now, this is the indicator. It's highlighted here. It's displayed here. So if you want to change it, this is where you access the settings. So the first change I'd like us to make is just the style of it, the color. Just the color before we get into what it does. So let me paint it black. Let me just make it a bit thicker. Where is that? Somewhere we'll change the thickness. Yeah, right here. So this way you change the thickness. Alright. So what's a moving average? Alright. Moving average, what it does is it takes a number of past candles, and takes the averages of either the opening, the close, the high, or the low. Alright. So you remember those attributes of a candle. We said a candle, for example, this green candle here has an open, which was here down here, has a close, which is where the body ends, has a high, which is on top here, where it touched the highest price value, then it has a low, which was the lowest price value. If it's a red candle, it's usually inverted. The opening they go on top, the close is where the body ends at the end, at the bottom there. The lowest is where the lowest price value that was touched, and the high was the highest point that that candle touched. Now, what a moving average does is takes a number of a specified number of past candles. Maybe, for example, the one we have here by default has taken. We go to settings. At inputs, you can see it's taken. The length is 9. It's taking the past 9 candles and taking an average of the close of that candle. Okay, of the close of that candle, and then plotting itself. That line plots itself on those points. All right. Then it just moves into the future as price moves. I don't know if that's clear enough, Yvonne. Still there, Yvonne? Yes. So a simple moving average just takes averages of whatever property you've yes, but I'm recording, so don't take too much time writing it down. I'll provide the link unless it yes. Hope today our link will behave. A recorder, yes, you can see it's recording. Sawa. So you might ask how you'd use averages of maybe the close in this instance as an indicator to trade, or how is this moving average used? So different traders use different lengths of candles, but the basic idea is that when the price is above the moving average, the direction of the trend is up. The trend is bullish. When price falls below the moving average, the trend is bearish. So that in essence is the idea behind a moving average. Usually, for example, you see the average we're using here, the 9. Yes, so usually the 9 that comes by default here, you can see on this particular time frame we're in, the 15 minutes, it would be difficult to trade it because you can see the price goes up, down, up. It, just crosses the price crosses the moving average quite a number of times. So you need to adjust this to make the signal, so to speak, a bit more clearer. So on a 15-minute, what I'd suggest, we adjust this to, let's try 20. So we can take the last 20 candles to provide a clearer picture of the trend. Let's see how that plays. Yes, so you can see after we changed it to 20, the line is now plotted differently. So even so, there's breaches. It's not as irregular as the nine figure. Yes, you have a question. Yes, in this case, it's taking the average of the last 20 candles close. the closing value of the last 20 candles. So if we're here, like right now, the price is here at 2030 UTC plus 3. It's taking the last 20 candles to plot each point. Sawa. No, you ask the right questions and the right number of questions. So, in fact, the questions are very welcome. What's how it's supposed to be? So you can see how we're playing around with the averages. So you need a smooth, clearer picture, so you can be able at least to trade. Personally, I don't use the moving average on lower time frames. On higher time frames, for example, if we go to the 1 day, we click here, change the time frame to 1 day, using the same 20 moving average. I find that using the moving average on higher time frames or larger time frames gives you a better picture and is very good. It's an effective trading tool on for the long time, for position holders and for swing traders. Now, for example, if we were to change, I find that with Bitcoin, one of the best moving averages is a 100 if you're holding for long. The 100 moving average. So you see the 100 moving average on the daily time frame with Bitcoin gives you a picture that says we're bullish. All right. So what you'd have done with this moving average, it turned bullish around when? Around February 19, at around when Bitcoin is around $3,880. So if you bought there, the next place to sell would be once it breaches this moving average. So let's see what profit you'd have had. You'd held a trade from 38.80. Once it closed, it breached the average and closed. Let's just use 38.80. Let's project the price to where it is right now. So as you can see, we're using the price tool. Remember this price tool we looked at yesterday? I hope you remember it. So let's in fact change the price tool so we can use both the date and price tool combined, so we can know the length of time and percentage change. Alright, so I hope the screen is clear for you. If you'd have held, if you used the moving average to trade Bitcoin on a 1 day time frame, and your entries were as simple as it crosses above, you buy, it crosses below, you sell. So it crossed above around the 21st of February 2019. Price has held all these months, 151 days to date. 151 days to date. It has held, it's still bullish, it's still above the moving average. You can see that's 165%. So if you had your, I know you're a millionaire, Yvonne, if you had your 10 million over there invested, you'd have 165% of in gains in those few days. Yeah, so that's how use a simple moving average. All right. Yvonne, is this clear so far? Yeah, you've gone silent. Dimension. Yeah. So you see, this is a very simple way to trade. No, it's a very simple way to trade, and I think if you have enough capital, you can have one account or one investment for long-term holding, because Bitcoin is the best performing artist the last 10 years. So it wouldn't hurt, in fact, be very, very good. Now, if we look back, all right, so this whole year since February, we've been in an uptrend. We're using 100 average, 100 moving average. When would you have begun to sell or to go short or to get out of your last long after the 2017 bull market we had? Remember in 2017 Bitcoin went to its highest value, its all-time high of 20,000 USD. Yeah. So if you are using the 100 moving average, let's see where you'd have entered this trade. In fact, you would have entered around, March thereabout, March, February thereabout 2017. And you can see, apart from this one instance here around July 2017, where we had a close below the moving average, you would have ridden this trend up until, let's see, up until 23rd January 2018. So you'd have ridden BTC from what percentage, from what number, from, let's assume, $1,000 up to around $10,000. So you can see it's a simple, clear way. In fact, if you have guys who are not too much into technical computer stuff, it's just, but they're interested in trading, usually advise just keep it long term, keep it simple, use a simple moving average. As long as you have the right, number of candles to plot the moving average, you're safe. Now, of course, there are times where you have what we call fake breakouts. So if you would have sold here, if you would have shorted here or exited your long here and went short, and the conditions remain the same, you'd have ridden this trend up until around 24th April of 2018. You'd have exited because it crossed and closed, on top of the moving average. There are ways to avoid such false breakouts. One strategy guys use is to look at the inclination or the slope of the moving average. Okay, so if the moving average is still sloping downwards, you might exit, but you will not enter along. All right, so you'll wait for it to cross back down again, and then re-enter your short position. All right, is that clear enough? Let me know if I'm going too fast. All right, so I'm saying, you remember that condition of once it crosses the moving average and closes, so it has to cross and close below the moving average. So once it does that, you exit. If you are going long, you are going long, you exit, because the market conditions are now changing. We've crossed the moving average, we've closed a candle below, beneath the moving average. So that signals that the trend is changing from a bullish to a bearish. Sawa. That's clear up to there. Let me just know. There's a problem. It's clear. Okay, sawa. So, now we've said also sometimes indicators give you false signals or false information. So you need a way to counter or to minimize your risk in case of a false signal. For example, here, price came, crossed the moving average and closed above it, right? in a basic way, one would assume, oh, it's crossed and closed. The trend could be changing to a bullish one. Let me exit my short and start preparing to go long. But you see then what happened? It crossed back down. All right. So if you were going long here, you'd have gotten a loss. A bit a small one, but it's a loss nonetheless, considering you're trading long term and with large amounts. So that's what I was explaining. I don't know if it's now clear. If it's not clear, let me just know what needs to be clarified. Good. So how do you avoid false signals or false breakouts using the moving average? One way is to look at the slope. You see, when it's sloping downward, trend is likely, it's signaling that the trend is still bearish. This trend is still down. So even though it's crossed the moving average, all right, as long as the trend, the slope here is downwards, you would be a little, careful entering for a long position, into a long position. So you'd wait to see if the price re-enters the downward channel, crosses back beneath the moving average. All right, and then that would be a clear signal to re-enter your short trade and continue the move down. Is that clear enough? Good. So you'd have exited at around April 23rd, 2018, and then re-entered at around May 14th, 2018. And that's like a few weeks, 2-3 weeks. So once you re-enter that trade, you ride it down. Of course, you don't always have to, wait for those conditions to be met to exit. I mean, if you re-entered here, for example, if we took this price and date tool, you re-entered here at around 87 and you are shorting. By the time it reaches, down here, you already have 34% in 41 days. All right. So there are ways where you don't need to wait for all this pullback to clear your gains. You can have what we call stop losses. A stop loss just helps you lock in your profits. So, for example, you can put your stop loss at around, you can say every 10% move, you'll put a stop loss. Even if it goes back again, it won't, you'll conserve the gains you've already made so far. Right? So that's just to protect your profit. So let's see. We'll look at stop losses deeper when we start looking into exchange trading. So here was another false breakout. All right. At this point, at around 24th July 2018, we had another false breakout. It crossed to signal a bullish trend or the end of a bearish trend, but then again re-entered crossed beneath or below the moving average. So there again you'd re-enter because it's still sloping downwards to indicate a downward trend. So those false breakouts are a common thing, all right? Especially if you're trading using this indicator on a low time frame, 1 hour, 4 hours, 15 minutes, 5 minutes. Trading this indicator on a low time frame wouldn't advise, especially on volatile assets, which Bitcoin is. Bitcoin is very volatile, so you don't need to trade using the moving average on lower time frames. Keep it simple. Stay with swing trades and position trades where you trade for days and weeks and months, if not years. All right. So a false breakout, re-enter because it's still sloping downwards. Another false breakout here, re-enter because it's still sloping downwards. Now, once you re-enter after this cross downwards, September 2018, there was no other false breakout. All right. So since 6,600, you would have ridden it all the way to the next cross. You'd have had 41% shorting, 41% movement short in 167 days. Now you can see this is why this is advantageous for people with capital, large capital. So if they can afford to wait that number of days because they are investing large capitals, the gains will likely be significant just using the moving average. So the next time Bitcoin crossed the simple 100 moving average, we actually did have a proper bull trend. All right, so you can see it crossed, and around that time the slope, you can see the slope of the moving average flattened. It went horizontal, so that shows you that it's maybe changing from a downward slope, anticipating a change to an upward slope. So that would have been a good place to re-enter during this phase here, and you'd still be in that trade with good profit. So the most it went to in terms of most price grew in percentage, the very top of $14,000 was 260% in 100 and let's say 25 days. All right, so that's not too bad. It's not too bad. It's around for 4 months. Yes, now we're bullish in the long term, right? Using this moving average. All right, now we're bullish long term, right? But you always have to catch the trend when it's starting, because now if you buy here, maybe it's coming down to cross the moving average. So the best time to catch a trend is when it's beginning. All right, if you're looking to go long, you always want to buy as cheap as possible. So identifying this change in the tide is very important. Identifying when the tide is changing as early as possible is very important, especially if you're trading on margin, and if you're trading volatile assets. You don't want to be as a long-term trader, but how long-term are we talking about? Are we talking weeks, days, months, years? Okay, as a short-term trader, we don't use, I personally don't use moving averages, for the reason that this moving average, we've said, it uses past candles, a past number of candles to paint itself. So in that essence, it's what you call a lagging indicator, right? It's using the past to tell you the present, but so you're using, there's no way you can rely on the past to check the present if you're using short time frames. Of course, there are ways, but it's usually won't work. So this is a lagging indicator. It uses past price action or price attributes to paint a picture. Yes, moving average is mostly for long-term traders. Of course, the short-term traders who use them, they have their ways they use them, but I wouldn't advise it. I don't advise using lagging indicators or any sort of indicators, so to speak, if you're a day trader, intraday trader. Yes. We're not bashing indicators. Of course, whatever works for different traders, respect to them. But it's just now my experience. What's an AR? Is there an AR? What's an AR? AR, MA goes with AR. Let's just look at that. Maybe I know it. Oh, AR, MA, ARMA moving average. Let me just look at this. I'm seeing some forex guys talking about ARMA. Okay, for in our case, it's there are many indicators. So some I don't know them, but I can see guys up are talking about ARMA. I'm not sure what they do or how they work. Autoregressive integrated moving average, something like that. That's what I believe I'm seeing that ARMA represents. Yeah, I have no idea about ARMAs. I can see guys discussing them hapa. I can see guys discussing them. Actually, some important, some popular forums for learning these things could be forexfactory.com. You'll find guys talking about these indicators there. You can just search them and find forums for guys who specialize in these indicators. You can use the MetaTrader forums. MetaTrader is a platform guys use for trading. It's an engine for trading forex and other instruments. But I'm not familiar with ARMA. Let's just go to Wikipedia and see if we can learn something new. And okay, in statistics and econometrics. Okay. Alright, it's too much for me to read at the moment, but I see a lot of calculus and such things. Yeah, but it's good. Yeah, I look at it and I like to learn new things on trading, so I look at it and see what it's about a little later on. But I hope using a simple average is now clear. So if you were to go long, for example, if someone was to seek my advice, like maybe my mother, who I wouldn't dream of, making her have a loss, I'd tell her, no, right now is not the time to enter this market, right? So my advice to her would be, maybe when the price comes back and touches the moving average, maybe then you can enter. Or if the price crosses and re-enters the upward no, just above the moving average, then I'd advise her to enter. But right now, it's a bit too expensive for me to enter as a long-term trader. The right place to enter was down here. All right, so you always buy wholesale and sell retail. What that means is you buy at a wholesale price where the big banks and the institutions are buying. Yeah, they want to be buying here after everyone who's riding this trend is taking their profit. Yeah, you want to also be taking your profit up here. That's the idea. So just think of it as you do any other thing in your life when it comes to, yes, so if you're holding long term, that is, if you're buying long term, in terms of days, of course, if it's in terms of years, if you want to look at Bitcoin, to hold Bitcoin for years, 10, 5, 10, 15 years, I'd advise you to buy if that's your plan. It went up to 20,000 and it's at 10,000. It's a 50% decline. So a good place as any to buy if you're holding very long term. And going by the information that BTC is the best performing asset in the last 10 years, why not? Of course, never invest, whether BTC, whether anything. Don't invest an amount then you're not willing to lose. Yeah, a screenshot of this. Yes, let me just screenshot it and then I'll send it to you sometimes after class. The MA chat. Oh, by the way, you have it on your, I gave you the link to this but let me have a snapshot here. Let me take a snapshot and then I'll send you just check your that. You'll have a snapshot and then let me just see if I can compress it further. Sawa, nitakutumia calls up. Compress it further to a fuller image so you can see both the past and the present. It's a bit compressed. Gives you a clear picture. That's not bad. So let me screenshot this. Alright. Sawa. Let me send you then I send calls up. Let me just copy it. Alright, but I hope so far so good. Alright, I sent it to you. That's a TradingView snapshot. I'm not sure how long it stays online. You can just download it sometime and save it maybe as an image on your phone. Alright, so shall we continue? Do you need a break? It's 1 hour in already. Let me know. Good. It's good to hear. Alright, so when would be the best time to buy? For me personally, I'd wait for this price to touch the MA. Alright, I'd wait for it to touch the MA to retest it. Okay, that's called a retest. Yes, we took a break before class, so let's continue. So what's a retest? this would be an example of a retest right here in 2017. Now, just assume we're having this class in 2017. All right, and you're asking me whether it's a good time to buy. And assume we're at this point right here, around here. All right, and you're asking me, is it a good time to buy? Of course, long term, it's a good time to buy, right? But why not wait for this retest here, buy cheaper, and ride it up? That makes sense, right? Or if you were to assume that we were here at this point here, and you ask me, is it a good place to buy long term? Of course, it's a good place to buy long term, but who in 2017, 10th in the September, yes, people are bullish and all that, but still doesn't mean you buy. The trend has already exploded. It's always good to wait, just as in everything in life. When you're buying stuff, it's always good to wait for the best price. So the best price would be to wait for this retouch or retest of the moving average. So here I'd tell you, yes, here buy, so you can be very comfortable just riding the wave up with no pressure, no blood pressure rising and all that. Because imagine you've bought here or up here at 49,000, 5,000, and then you see it going all the way down. So you'd put maybe $1 million shillings here, then you see it going all the way down to 2,800. You'd sweat, and that's over a number of days. So what most new traders, the mistake they make is buying too expensive. All right, is buying when the price has already moved. Always wait. Market will give you another chance. If the market has left you, that's okay. Wait for the next train. It will always come back. Markets do not go up in straight lines, they go up in zigzags. So wait for a retrace. Be patient, wait for a retrace. You will be rewarded. Then buy at the retouch. All right, so you can see here when price touched the MA here, you can see it exploded upward. You can see this green candle, we call them dildos. It went up in an explosive move. That means smart traders, who we call smart money, the smart money was waiting here, all right, while the stupid money was sweating, seeing the millions go to waste. Smart money was waiting here. Smart money is always patient. Smart money looks at things, in a practical, realistic way. Smart money is not guided by emotions and euphoria. They always have a level head. They know money is precious, so they wait and manage their capital in a practical and effective way. So imagine someone who bought here after this dildo closed and exploded. That's someone who waited, akangana. They saw, okay, it's retouched the moving average, good. Now let me wait and see if other buyers are waiting just like me. This big explosive move tells you, yes, there are buyers who are waiting down here just as you. So now you're very confident to enter that trade. No pressure at all. Then you ride that whole movement up. Imagine buying Bitcoin at 3,000 and riding up, seeing it go up to $20,000. It's a huge percentage gain. So that's how you trade the moving average. Oh, it's a link. It will take you, the screenshot is a link to a photo. Then you screenshot that photo. Or are you able to do that? on your phone? Yes, good. So one of them is zoomed out to 2017, a bullish market up to now. The other one is a snapshot of the recent 2018 bull market. Now, that's how you trade this moving average. Just to recap, the important thing is to understand your market and asset, so you can know what time frame to combine with what number of past candles. So for Bitcoin, 1 day 100 is perfect. Now let's look at a more advanced way to trade the moving average. Okay, so another advanced way to trade the moving average is to combine two moving averages. So this strategy is called moving average crossovers. Okay, moving average crossovers. Take a sip of my tea. Now, moving average crossovers. All right, 1 minute break. Good. That's awesome. So let's continue. Yeah, it's good to share knowledge, And with this simple moving average, you have good capital. Just don't be afraid to start using it. Of course, you manage your capital using risk management, various risk management methods, which we look at. Then You manage your trade as well. If you enter a trade, always know when to lock in profits, or where to lock in profits. You remember price goes up in zigzags, so during those zigzags you can add to your positions. The next retest, add to your positions, so some of those things. So long term Bitcoin right now, it might continue up, yes, but for me, I'd wait for it to touch the moving average. Now this was just using one moving average. There are ways, there's another method to use 2 or more moving average. We call this the crossover moving average strategy. So here what we do is we just add another moving average. So now we have 100 moving average. Let's add another moving average. With Bitcoin one day, using the crossover, what I usually do is add the 200 moving average. So I'll take a normal moving average like that, and go to settings right here, change from 9 to 200. So now this one is taking the last 200 candles. Go to color, change color now. The first one I had is black. This one I'll change it to red. Let me change it to red. Change the thickness. Change the thickness right here. It usually escapes me, but let's use that. Okay. And say okay. So now we have the 200 moving average and we have the 100 moving average. Crossover strategy. How does it work? Okay. Now the 100 moving average, since it's taking the last 100 candles, will reflect the trend much, to paint a much more recent picture of the trend as compared to the 200 moving average, because 200 moving average reaches far back into the past to plot itself. Are we clear up to there? Good. Now, how do you trade the crossover? All right. Let's start back with the 2017 period, so we can best see how it works. We just delete this. This plotting is with the made. Now, the idea behind using 2 different moving averages is to give you more assurance of the change in trend. So if you want to go bullish, you wait for the moving average with the lower number of candles, all right, to cross above the moving average with the larger number of candles. The lower number of candles moving average is the faster moving average. So the 200 is the slower one. The 100 is the faster. Now the idea is that the faster one is fast because it's changing pretty quickly, because it's using the last 100 candles. So it's reflecting the trend much more quickly. Now the slower one is used as a support. Like we're using it to see if it tells us the same story as the faster moving average. All right. So in this picture here, let me just extend this. For example, now I'm just drawing. Let me change the color. Let me see if the color can change. I'll change the color of this brush. It's right here. dash 2 right here. It's the right trend. Now I'm just extending it because BitMEX doesn't have history of the 200, doesn't plot past that point. So now here the faster moving average has crossed the slower moving average. Okay, so we're not just using the criteria that let me just disappear the 200 kidogo. When we were using the 100, we were just saying we want price to cross above it, and after it crosses above it and closes above it, we change our perception to long. I'm a bullish market. Okay, now with the crossover strategy, after it crosses the 100 moving average, the slower one, the faster one that is, some people will wait for the 100 moving average itself to cross above the 200 moving average. Let me know if things are clear up to there. So price crosses above the 100 moving average, and it crosses above the 200 moving average, but also, all right, so what's not clear? Let me just know so I can expound. All right, let me just begin again. So the concept is to use something we call confluence. Confluence, just we want to if it's a bullish trend, we just want to be sure, kabisa. So one way that guys use to be sure is they apply a slower moving average, like in conjunction with the faster moving average. Okay, with the faster moving average. So in this instant, the 100 is the faster, the 200 is the slower. So when we are using just the 100, we are waiting for price to cross above it. But when you're using a crossover strategy, you're using two moving averages, you also want the slower moving average to cross the faster moving average to cross the slower moving average. So if we're just using the 100 moving average, let's assume it's right here. Change the color to black. If we're using the 100 moving average alone, let me just hide the 200 for now. We'd buy after it crosses and closes above, right? Up to there, are we clear? Now at this point, I'm just recapping the 100 first. Yeah. Now, with the double moving average strategy, these moving averages also cross each other. Okay, so the trend is bullish when the faster moving average is above the slower moving average. When the 100 crosses above the 200, the trend is bullish. We clear there? Yes. So now you're adding on top of ile strategy ya kwanza, right? So the first strategy was price crosses above the 100 moving average. Good. Now this new strategy, apart from that, you also want your 100 moving average to cross the 200 moving average. It's called the golden cross. So you wait for price to cross the moving averages, go above. Then wait for the golden cross, and you have a confirmation of a bullish trend on the long term. It's as simple as that. Is that clear? So price crosses, then those averages also cross. Yes, good. So you have the golden cross, which signifies a bullish trend. All right? Yes, you have the chart right here. You have the chart right here. Do I send you another screenshot? I'ma first explain, then send you the screenshot. All right. Oh, you mean the link I sent last time, eh? All right, let's continue. So, the main things you're looking for is for the price to cross the moving averages in whichever direction. So if the price crosses upward above them, like here, crosses and closes upward, it signifies the beginning of a bullish trend, right? It signifies it's not confirmed yet. So you can enter a small amount there, okay? Let's say maybe you had £1,000,000 shillings that you invested and you want to go long term bullish. How would you trade this scenario? You'll trade it this way. Price has crossed 200 moving average, then price has crossed the 100 moving average, right? Sorry, the 100 first, then the 200. It's crossed them. So after it crossed them and closes above them, you can put maybe 200,000 shillings into Bitcoin. All right. Then you remember you have £1,000,000 shillings to invest. Then the next portion of your investment would maybe come after you see the 100 moving average crossing the 200 moving average. Then you add another 250. All right. So let's assume first we put 250. Then now we add another 250,000, 250. Okay. So you're trading this confluence because it's telling you a similar story. So now the trend is getting to being confirmed by different criteria of using this double moving average. Yeah? So up to there, are we clear? Let me just know if we're clear up to there. Yes. So now remember you have 500,000 remaining. All right. This is just called equity management. You're just managing. You don't want to go all in. Now, when would you invest your second, your third $250,000? You'd wait maybe for a retrace to the 100 moving average, then add to your position, add your 250, what do you call it? 250,000 shillings. So now you have 750,000 invested, but you've averaged in, you've laddered in. Okay, so your buys are averaged in. You did not go dump the whole 1,000,000 inside into this investment. So now you're becoming a smart investor. So now at this point you have 750,000 invested. You can wait for it to ride and put in on the second pullback to the moving average. You add your other $250,000, all right? And then ride the wave up. Sawa. Is that clear? There's some people who wait for just for all the conditions to be met before they put their first the investment in. It's okay, different people trade differently. But I found that averaging in or laddering in your buys, your sells, gives you a good average entry. It also gives you the opportunity to confirm that trend. So even if the trend, does not pull back and just continues a parabolic move up, you had something in on the table, right? You had your first 250,000 that you put after price crossed the moving averages, right? Now, another person, apart from the moving averages crossing, will wait for the slopes to turn upward and maybe use that as a criteria to add. Sawa 1 minute break. All right, let's continue. So so that's that. So how do you exit that trade? So now we're assuming Yvonne has invested 1 million shillings into this thing. You've averaged, you've laddered in your buys. Bitcoin has reached $20K. So how would you, being smart is, knowing when to exit, when you have your profits, and where to lock your profits. So just don't assume that, price will keep going up. After you've made maybe 50% of your profit, you can decide, okay, let me take some money off the table. So the 1 million has turned into 1.5. So you can decide, let me now take off the 500,000 profit I have and let the 1 million continue trading. Let the 1 million continue trading. And then say this 1 million, as it trades, I'd start getting out of my position, reducing my position as it goes upward towards whatever high the price will end up going to, because you don't know where the price will reach. No one knows. No one can tell you we're going to go here and here. No one knows the market. No one can tell the future. Tomorrow news can come out, oh, these people are trying to ban Bitcoin, oh, this and this and this. And in the past, that used to affect the price of Bitcoin a lot, especially, remember, around 2017, up August. We had that scare with BTC being banned in China, and we saw this big drop here. It was in September or August. It's called the China FUD. The China FUD. So you always have to protect your position, manage your trade. So the same way we entered the long, you'd now enter your short. So you've taken your profit, or you've waited for the price to cross the moving average and exited your position. You're now preparing to go short. So one trader would enter here. So you have, let's say, 1 million shillings again. You've exited the whole million. As you've rode, you've taken your profit that whole year. Now BTC has crossed the 100 moving average to the downside. So you're now preparing for a bear market, or shorting now, or selling. So you could wait for this close here and say, let me enter with 250,000. So now you're laddering in your sells as well. So you short 250,000 there. Then you wait for the cross. So remember, a bullish cross to Liita, the golden cross. Okay. A bearish cross, where the 100 crosses the 200 moving average, is called the death cross. Just means the market is now about to tank. So another person would add their position after the death cross. Add another 250 there. After you add 250 there, you wait for maybe sloping to turn, the slopes to turn from upward to downward, which happens around here, and add your position, maybe add your 250,000 there. Then you can wait for a retracement back to the moving averages and add your final position there. Then give the trade now time to mature. You give the trade the time to mature. You have a nice average entry because you averaged in your cells. You're shorting now. You short, you short, you short, you short. Manage your trades. Have a stop loss. Have a risk limit. Have a trailing stop loss where you're just trailing the prices. It goes down. You're saying if it retraces, I have already locked in 50%. Okay. Of course, at this time you should have already started taking some partial profit off the table. And that's that. So now let's look at the next bullish turn which occurred this year. We had, if you're using the 100 moving average alone, you'd have entered at this point. But since you're a smart investor, very conservative, you wait for the slope to turn and you wait for the golden cross. So the golden cross occurs around here. That's May. You make your second entry around May. Now you wait for a retracement back to the moving averages around July, June, July, August. August, it's not already happened. Maybe it should happen in August if price retraces back to the moving average. Make your third buy. Alright. And the slopes as well. You could make your fourth buy using the slopes. So that's that. That's that, Yvonne. That's how you trade long term, conservatively, using 2 moving averages as well as 1 moving average. Let me know if there are any questions. All right, but so far so good. Everything is clear. Is something you need clarifications or to be expounded on? Let me send you the screenshot. Let me snapshot this. All right, but hopefully you'll remember. So yeah, I notice after 1.5 hours, 2 hours, usually concentration. Yeah, it's okay. So let me send you this snapshot, and I'll send it to your WhatsApp. So that's for the golden cross and the death cross. Can use just those two. You're a conservative trader. You feel a bit aggressive, you can just use the 100 moving average. So Yvonne, the next indicator I'd like us to look at is the Ichimoku cloud, which we will not get to look at tonight. It's quite detailed, more than the moving average. But let me just put it up. You can just go through it during your own time. But I want us to look at it tomorrow. It's a whole other hour and a half of it, looking at it. Yes, it's called the Ichimoku. Ichimoku. That's a Japanese word. They call it the Ichi. Yeah, this is it. It might look clustered right now, but we'll tweak it a bit tomorrow. It will be a look less convoluted. That's the Ichimoku cloud. We'll look at it tomorrow. A very, very interesting indicator. Yes, please ask. Yeah, one question, then we call it call it a lesson. Now remember, these indicators that I'm showing you are mostly for apply them for long term. So I'm not teaching indicators to be used intraday. So you'll be applying them long term conservative trading position and swing trading. You have a substantial amount in capital. You don't mind waiting. Good thing is be assured of profit in the long term using these indicators. So you're asking whether forex trading will help you with your trading journey, or oh yeah, no, it's good to read Baby Pips. As you said, we borrow a lot from forex. These trading strategies are all from forex and traditional instrument trading. So feel free to read Baby Pips and all those. But it's good to be just, this information is too much. It's too much. That's why it's very advisable if you're beginning trading, just get someone who's been doing it so they can just point you in the right paths. Because if you were to, just decide to just get in and just consume whatever material you get, you'll never get to trading. You'll try out this strategy, try out that strategy, try out, And I don't know if Baby Pips talks about crypto as well. You see now with crypto, people have been now doing it for, let's say 5. People have been doing it for 5 years is when the last 4 years when active trading has happened, like speculation and exchanges have come up in the last 5 years, and people who dived into it have already collected a bunch. Oh, I'm breaking, already collected a bunch of am I okay now? Yes, I'm saying crypto traders have already coalesced or collected their own materials from all those other places, sources of information and knowledge. So once you decide to go into crypto, just go with the information that is distilled by people who are in that market. They've already borrowed this information from forex and all that, so you can go to Baby Pips to understand the basics of how analysis works. But once you decide to get into specific instrument, that instrument has their own universe, a small universe that is either on social media, groups of people who just talk and invest in these tools and share analysis in those specific tools that you've gone into. But Baby Pips is okay to just understand the general knowledge of what trading entails. Let me just close this recording. We can keep talking, but let me just